I'm going to motion to have Brian Keeps chair the meeting today.
Why don't you ask
For a motion. Yeah.
Second.
Okay. All in favor?
Aye.
Any opposed? Okay, thank you. I believe we have full attendance, so welcome to both the Financial Sustainability Committee and Board of Trustees this morning. I will open with public comment. Anyone have any public comment? Seeing none, I will close public comment. Next, approve Financial Sustainability Committee minutes from October 26, 2022. Do I hear a motion?
So move that we approve.
Support. So that was, okay. Support?
Support.
And all in favor?
Aye.
Aye.
Any opposed? Motion carries. Okay, I am going to give an overview of the, I'm going to pass out, I don't know if we all have them, but this is the report prepared by, that you received, the quarterly investment report as of 12/31/22, and that was in the trustee packet at year end. This report has been revised and updated, and I will discuss that as we talk here. The first item on the, so last year at this time, and we're going to get into, Brian Green will kind of discuss and give you an overview on interest rates and what it's done in the fixed market. But last year at this time, I think we had all of our money in the Oakland County local government investment pool, and we're yielding at that point a whopping, I think it was 50 basis points. Which was performing very well compared to all of the other short-term investment options that we had. This year, you see both the Oakland County local government pool, and that's at 1.925. So last year, I think we had about 70-something million in that. We've significantly reduced the amount because at this point that's yielding about 1.3%. We started buying, as I noted earlier in the year, a ladder of T-bills. We are at roughly 24 million. The T-bill duration is 2/3 of a year. We're currently yielding about 2.9%. The closest maturing rate is, or T-bill is on March 31st at like 1.7, and then the furthest matures on 6/30/24 at a little, almost 4.6%. So you can see how rates have been increasing steadily over the year in terms of in the ladder that we've been buying. The new item is the J.P. Morgan Chase Money Market Daily Sweep. We have $43 million in that account. And what we did is earlier in the year looked at these different options, and we're working actively with J.P. Morgan to see how else we could invest our money. And they have a sweep account where we keep basically $5 million in our accounts, and everything else on a nightly basis is swept into an investment. The investment that we've selected is a J.P. Morgan U.S. Government Money Market Fund. We're an institutional share. That rate on that money market, on that fund, as of January 25th, is 4.08%. So we've been able to kind of diversify our short-term money and how we're investing, and that is the revision that you'll see from your investment report from what was initially provided to this investment report. The other item I want to update the board, our committees are on the Prudential or Empower and formerly Prudential, who's the holder of our guaranteed deposit account. The new money rate is 3.6%. Last year, again, to give you a sense of what they were, what we were earning on our new money, was 1.5%, so over double. The existing money rate is 2.75. Last year was 2.55. So we're seeing our new money increase significantly. The existing money, we're now trending up, which is a good sign, because this year, I think with rates, we'll even see better going forward. So those are both positive for our investments in the operations area and the defined benefit, we're still calling Prudential GDA, which is, at this point, if you look down on the defined benefit plan, at $139 million. And that's clearly our most significant investment for the township has. With that, are there any questions in that area? Okay. I'm then going to turn it over to do a review for the fourth quarter and 2022 financial review for our defined benefit equities, and I'll call Brian Green from ANCO to present that.
Thank you, sir.
Thank you.
Thank you.
No. Yeah, you know, I'll take one, thanks.
If it's the same one, I don't need it.
Okay, how are you?
Thank you, sir.
Change my jokes a little bit, given the some have already heard them. So start the conversation with beware an investment advisor that brings colorful charts and graphs, because it usually means the numbers are difficult. Calendar year 22 was a stark reminder for investors that stock market can in fact go down. We're going to talk about the fourth quarter, which was positive news across the board, not only from a stock market not only from an equity market standpoint, but also from a fixed income standpoint. But because we're talking about calendar year 22, because it's January, just want to have a conversation around everything that happened last calendar year. So in the chart package that Mike passed out, what we have on page one is a dot plot of calendar year returns from 1976 to present for the S&P 500, which would be the 500 largest stocks here in the U.S., bar a few, and the Bloomberg U.S. Aggregate Bond Index. And that U.S. Aggregate Bond Index is a proxy for high-quality U.S. investment-grade fixed income maturing in the next 7 to 10 years. Think about it as kind of the Dow Jones or S&P 500 equivalent of the U.S. fixed income market. There are probably 30,000 bonds in that. So the y-axis, the vertical axis, measures the S&P 500. So obviously the higher the dot, the bigger the return. The lower the dot, the worse the return. And as you work your way from left to right, on the x-axis, that measures the U.S. Aggregate Bond Index. Well, what should jump out immediately is the fact that there's red text and a green dot in the bottom left-hand corner that represents calendar year 22. And you can look at it from a magnitude standpoint and say, okay, from top to bottom, this wasn't the worst return we've seen out of the S&P 500. 2002 was marginally worse. 2008 was definitely worse. We weren't down 18% like we were last year. We were down 37%. But from a left to right standpoint, it is definitely an outlier to the far left. Worst return in the modern history of the capital markets for fixed income. Worst return in the last 100 years, really the measurable. And the joke that we've seen is it's from like a U.S. Treasury standpoint, it's the worst return we've seen for treasuries since George Washington was in office. And all of that's meant to bring some humor to the fact that literally last year for traditional fixed income investors, it was the worst experience they've had. It was the worst return they've had. And it wasn't because of bankruptcies. It wasn't because of insolvencies. It wasn't because of missed payments. It wasn't because the federal government hit their debt ceiling. It was flat out, as Brian had mentioned early on, because of the magnitude and significance of the interest rate increase. So let's talk a little bit about last year's volatility. So page 2, looking at the S&P 500 from 1928 to present, so it's the entire history of the S&P 500. Green chart at the top is the percentage of annual trading days greater than 1% to the positive side. So think of these as the really good days to be an investor, right? When you turn on channel 7, turn on channel 2, whatever your evening news of choice, and they talk about the S&P being up, up 1.5%. It's always expressed as points, which is frustrating to me because, a 300-point move on the Dow today is not a 300-point move on the Dow of 10 years ago, right? That's a 1% move now, not a 3% move. Historical average is 12.5% of the trading days in a given calendar year are up more than 1%. Last year, 23.5% of the trading days were a move greater than 1% to the positive side. Well, we just said we were down 18%, and then you just told me that last year we had double the great days. Well, if you look at the bar chart, the blue bar chart in the middle, this measures percentage of annual trading days of negative 1% or worse. So these are the bad days to be an investor. Historical average, 11.7%. Last year, 25.1%. So, yeah, we had 2x the number of great days, but we also had 2x the number of bad days from a historical standpoint. The peak was in 2008. 29.6% of those trading days were in negative were a negative 1% or worse. Remember, that was a year when we were down 37%. What was surprising to me, right? So if you think back to last year, very volatile year, right? 2x the number of big moves to one side or another. This line chart at the bottom was surprising to me. So all we're measuring here is the percentage of annual trading days that are in negative territory. So not negative 1 or worse, just something negative. Calendar year 22, 57% of the days were in negative territory. Not 70, not 80, not 90, 57. The historical average is 46. So on average, 54% of the days are positive, 46% are negative. Not 70-30, not 80-20. The other thing that's interesting to me, and this goes to, look, volatility happens, and it happens a lot more than we think. Look at the highs and lows in terms of the number of negative trading days. The peak was in 1974 at 57.7%. So the worst year in terms of number of negative days was 58%. Not 80 or 90, 58%. The best year in terms of the least number of negative days would be, I'm going to call that 1953, 1954 at like 37%. So again, the skew is at most 60-40, not 70-30, not 80-20. So this idea of, as we look at it from a historical standpoint, volatility happens, and it happens a heck of a lot more than we think. The difference is when the overall directionality is skewed to the, if the 50-50 pivots to 55-45, positive to negative, we're going to be up. If it shifts to 45-55, and there's more negative days, then we know we're going to have a difficult year. I call page 3 treasurers walking to the office happy versus sad. Starting the year, if you were investing short-term cash, you were trying to find something north of zero. You were trying to find something that had a positive return, and in many cases, it would round to a positive return. If you bought a 1-month treasury bill at the start of the year last year, it paid you a whopping 0.06%. That same treasury bill purchase on December 31st would pay you 4.1. 1-year treasury, at the end of the year paid 4.7%. It paid 0.4 at the beginning of the year. So this massive increase. Everything you see on the far left is Fed-driven. So each rate hike that we heard last year drove those short-term interest rates higher and higher and higher. What you see on the longer end of the curve, 10-year, 20-year, 30-year, is market-driven. Well, we just talked about fixed income being down 13% last year, and that's all solely due to this increase in interest rates. Bond prices and interest rates are at opposite ends of the teeter-totter, so as rates have risen last year significantly, that's pushed prices down. So any losses last year on paper for bond investors weren't because of insolvencies, weren't because of bankruptcies or missed payments. It's just the market equilibrium, right? Rates have risen, so therefore prices have declined. And you can think about it, the example on a 10-year treasury. If I bought a 10-year treasury January 1, it's going to pay me 1.5% per year for the next 10 years. But I can go out and buy that same bond today and earn a 3.88% return for the next 10 years. Because those bonds, right, same issuer, near, almost, well, maturity date would be a year apart, but because those have all those same common elements, that treasury bond that I bought for 100 cents on the dollar, current value is probably about 80. So if I'm going to sell that because I want to buy something else or put that onto the market, because it's paying so much of a lower amount of interest on an annual basis, the price has to adjust. Page 4, rounding out the conversation of things from a diversification standpoint. Again, 1976 to present. Calendar year 22 from a traditional diversification standpoint, stocks and bonds was the second worst year, calendar year return for investors in the last 46 years. 08 beat it out by a small margin, but again, that was because the S&P was down 37% that year. Final piece I'll leave you with is the quilt. Every firm has a slightly different version of this. I promise you this one next year is going to have a larger font size. The idea here is pick a color. And it's really to recognize and show from a graphical standpoint that last year's winners are rarely next year's winners. Right? The leader in the clubhouse might get it 1 or 2 years in a row, but doesn't get it 3, 4, 5 years in a row. And this is why we have a diversified portfolio. This is why we have emerging markets. This is why we have fixed income. This is why we have a large cap value manager and a large cap growth manager. This is why we have real estate in the portfolio. Because, for example, real estate was the #1 performer last year. Everything else was in negative territory. Real estate was still up 7%. Let me walk you through it. Take top left corner. 2008, Bloomberg U.S. aggregate, so high quality U.S. fixed income's up 5%. So it's the #1 performer in 08, second from last in 09, second from last in 10, second from the top in 11. So again, that rotation of leadership from leaders of the pack to laggards of the pack. That same story is going to go through as we talk about some of the individual managers, because those that were laggards and those that struggled have held in and actually done really, really well so far this year. So I'll take you into the bound book. First, take you through just a quick firm update. So we've included an update letter from our CEO, Mike Welker. And we closed the year from an employee standpoint at 93 strong. I found this interesting. So this is my 7th year with the organization. When I started, I think it was 63 employees. We're now 93. So 30, right? We've increased our employee headcount by 50%. But what I think is most important for clients is when I started, there were 30 consultants in the firm. Today, there are 30 consultants in the firm. So individuals like Mike and myself that are out in the field working with clients, delivering advice. So those 30 additional people are in research, in finance, in IT, and all of the infrastructure and support that we need to continue to deliver strong results to clients. So we have an increased headcount in, frontline individuals that are out driving revenue for the firm. All of that employee, all of that infrastructure investment that we've made, all of that reinvestment of profits has been into additional talent to help us help you. Other important update, we decided to be a part of this conversation throughout the year as one of the partners in the firm, but we named 3 new partners. Brooke Wilson, who is our Executive Director of Performance Reporting, Tyler Grumbles, who's been with us for 15 years, and John Breath, who's been with us for 11 years. John and Tyler are 2 consultants based out of our Winter Park, Orlando office. So really excited to be a part of that conversation and see those 3 join the partnership. I'm going to take you into the book to page 6. I just think this mountain chart is very, very important. And it really measures so we just had a conversation around calendar year 22 being a difficult year for investors, right? The defined benefit portfolio for the calendar year was down 17.5%, the equity portfolio. But as we look from a longer term standpoint, you go back to March of 14, system started with $84 million back in April of 14. We've paid out, this is contributions to the GDA, just over $48.7 million. So absent investing this into the equity markets, we don't have $76 million today. We have $35.4 million today. So that 7.2% return, yes, we've seen a decline in value for calendar year 22, but because we have a longer term investment horizon, the equity markets, the real estate markets have added almost $41 million in value that wouldn't exist today if this were just sitting in PA20 cash related investments. So how did we fare? Now, remember, everything we have from an investment standpoint here is going to be equity, stocks and real estate. The real estate was a new addition. So for the quarter, overall portfolio was up 10.8, almost 10.9%. It was about 2% ahead of its benchmark, and middle of the pack versus other global equity managers. On a fiscal year-to-date basis, down just over 11%, in line with peers in the index, and for the calendar year, down about 17.5%. I'll tell you, if I can sum up Q4, it was a reward for patience. Managers that had struggled, like Edgewood and Oakmark, outperformed significantly. Managers like Clarkston that we had in earlier in the year outperformed significantly. Clarkston was actually positive for the year. It seems hard to get excited about a 1.5% return, but their benchmark was down 18. So just a fabulous amount of outperformance. But as you look on a manager-by-manager basis, Ancora, a little bit of underperformance for the quarter because they owned Apple, but stronger numbers on a longer-term basis. So Fidelity S&P 500, no surprises there. Interestingly, best performer for the S&P 500 was ExxonMobil, up 25% for the quarter. Tesla was the worst performer, down 54% for the quarter. Edgewood, large cap growth portfolio, up 9.2%, a full 7% ahead of their benchmark. Still struggling and behind on a one-year basis. A couple of notes here. Just two things that helped them. What they didn't own and then everything else. They didn't own Apple, which helped. Didn't own Tesla, which definitely helped. And literally every other 22 names in the portfolio, high quality, solid earnings potential, as we saw the market shift from being macro headline driven to being focused on individual companies and their profitability. All 22 names rallied. The other thing that's important to note is the partners in the firm inside of Edgewood collectively put $10 million of their own net worth into the portfolio. So this idea of, we're seeing some really attractive valuations, we're going to put our money where our mouth is, and we're adding more of our own personal net worth into these 22 names. Clarkston, solid quarter, up 11. Candidly, if you told me the equity markets were going to rally and we're going to see significant growth, I would have expected Clarkston to underperform, but they were almost 4% ahead of their benchmark. And as I'd mentioned for the calendar year, actually in positive territory. That's a 21% outperformance. Couple big drivers. Change Healthcare was taken out in early October. And then it was a couple of asset managers like Affiliated Managers Group, Franklin. Biggest laggard continues to be Altice, the cable company that we've talked about in previous meetings. Sitting on about 9% in cash right now, but I'll tell you with numbers like that, I'll continue to be patient. Fidelity Extended Market Index Fund, no surprises, up about 5% for the quarter. Flipping to page 8, to the international side of things as well as the real estate side. Big move in the quarter for international equity markets. As we saw the U.S. dollar weaken, international markets rallied significantly. Again, this idea of patience being rewarded. Oakmark, the names that drove performance for the quarter are the names that were causing them, issues earlier in the year. Prosus, Daimler Truck, Continental AG, Mercedes, all were positive contributors to performance. No surprises out of Fidelity in the International Index Fund. JP Morgan outperformed, up 11% for the quarter. I think of these as the Dow Jones of the emerging market world. Samsung, Tencent, Taiwan Semiconductor. They're underweight China directly, about a 22% position versus 30 for the benchmark. But if you factor in their exposure to Taiwan, about 7% in Taiwan versus almost a rounding error of exposure in the index. Put China and Taiwan together, and they have 30% exposure and are essentially index-like. Then finally, it's good news. It's good news for the year from a real estate standpoint. We did see negative returns, which was kind of expected, right? We saw rates rise significantly. We can't keep seeing real estate in positive territory. There's an inverse relationship there. So principal underperformance for the quarter, a lot more exposure to them. They're overweight multifamily. Almost 40% of that portfolio is in multifamily, think apartments, which if we're talking about a difficult housing market, renting suddenly becomes much more attractive. And a little over a third of the portfolio is in industrial, which continues to be a very, very strong asset class. about 19% in office and 8% in retail. Most of that retail is going to be grocery anchored strip malls. It's not Somerset. It's not Oakland Mall, right? It's not a traditional, it's the Kroger anchored center. Good news for them, overall occupancy for the total portfolio still sits at north of 92%. But if you remember, that portfolio is a combination of development as well as, stabilized properties. And if you look at their stabilized properties, the occupancy rate sits north of 98%. So still really, really healthy from an overall performance and underlying fundamental standpoint. And the other good news is TerraCap. So we put $4.2 million into TerraCap. Coming into the quarter, that 4.2 was worth 4.7. They sold 2 properties in the fourth quarter. So we got about a $400,000 distribution out of that. So we're already seeing, right, that money went to work in May of last year. You would expect to see negative returns for the first 12 to 18 months, and we saw positive returns right out of the gate and have already seen distribution activity, I would say, probably a year earlier than expected. So really good news coming out of that part of their portfolio. And remember, where principal is diversified by property type and diversified from a geographic standpoint, TerraCap is predominantly focused on the Sun Belt. Its exposure in Georgia, Florida, Texas, Arizona, right? Areas that are receiving, a massive influx from a population standpoint to continue to drive fundamentals in those underlying areas. So all in all, for the quarter, good news. Difficult year for investors from an overall return standpoint. There's no fixed income here to talk about, but pleasant. I would say, look, it's never easy to deliver negative results, but we're pleased with where the outperformance came from, and pleased that there seems to be a direct correlation between asking managers to come in, like Edgewood and Clarkson, and then immediately seeing significant outperformance from them in the ensuing quarters. That is the extent of prepared comments, but I'm happy to answer any other questions.
Any questions? Brian, we're going to be reviewing later the investment policies, but maybe while we're in the section, if you would just speak to the investment policies so when we get to that.
Sure. So from a best practice standpoint, i.e. keeping the auditors happy, we recommend reviewing the investment policy statement on an annual basis. And at times that can result in significant changes, at times that can result in no changes. And one of the most important things that's in that investment policy statement is the target allocations and the allowable ranges. So if you take a look, for example, at page 9 in the book, and I've got it up on screen, each asset class that we have, large cap U.S. stocks, small cap U.S. stocks, real estate, has a target allocation and then has an allowable range around that. And some of them are broader ranges and some of those are narrower ranges. And all of that's memorialized in the investment policy statement. And the idea is, look, we know we have a long-term target allocation, but the moment we invest that money into the equity markets or into the real estate markets, it's either worth more tomorrow or less tomorrow. So if it was a 50-50 split today, it's not going to be a 50-50 split tomorrow. It's going to be 51-49. It's going to be 55-45 because something went up or something went down. So we have those ranges to force action. It's really so that you can't fall too much in love with a given investment and fall too far out of love with a given investment. It forces action from a rebalance standpoint. So all of this is memorialized in the investment policy statement. And as we took a look through, we have no recommended changes at this time to the policy statement for the defined benefit fund, nor for the retiree healthcare. It's something that we do review on an ongoing basis. So if in July we felt changes were warranted, it isn't, well, no, we can't talk about it until January. But at this time, we have no recommended changes and would just recommend adoption as it stands.
Thank you. Any questions from the board and or committee? Okay, hearing none. Thank you, Brian.
Thank you.
Thank you, Michael. Now I will call Schwartz and Company, and we have both Walter Schwartz and Rob Higgins present with us.
Heavy.
You brought the big cheese.
Yep.
And
What can we do to kill less trees?
Electronic.
Yeah. Right.
So all of the money in this fund is if you add these together.
It's been sitting in your car all night.
So this report said it was 76 million. One
Yeah.
and these, they all add up to, that should add up to 76 million.
Yes.
Okay. And which one is Schwartz?
They are defined contribution,
Feels like we were just here.
deferred compensation, and retiree healthcare. No, yeah, that's what they're at.
Target Healthcare is ACO.
Yeah, yeah.
You're on his bad side.
And that's a retiree health savings plan.
And the
So
retiree
these
health,
three.
those two.
It's wonderful.
They do a good job for all the participants, too.
Good morning, everybody.
Morning.
Nice to see everyone again, for sure. I think I'm going to dive right into tab 2 and head to page 9. Certainly one of the the most important role, in my opinion, that Schwartz and Company has partnered with Township for is the education, meeting with individuals throughout the year. And we had I think another great year in terms of meeting people where they're at. So I've summarized on page 9 there the number of touches. Those are individual meetings, 72. Most of them Zoom, phone, email, in-person, remote, again, based on the individual's needs. In fact, just last night at it was like 6 o'clock, I was meeting with a firefighter and his wife. He's talking about retirement. So we met at the office. So proximity continues to be a good thing for individuals to get a hold of us. And it was a refreshing meeting just because the spouse was involved and just walking with them in their potential pivot into retirement. Within the next couple months, too, I thought this was a good tell. I had a direct call from the fire department, and they asked me to come in. Wasn't even coordinated through Elizabeth Parrott, which was, I don't know, I think that's telling to me that they felt comfortable enough. Hey, can we have you come out? So I'm going to be out at the fire department for 3 days, February 21st, 2nd, and 3rd, if you want to mark that down. But we'll give them an update and be willing to meet with people one-on-one at the station. So I'll hit all the shifts in that 3-day cycle. So good, I think good penetration on the education front continues. Lean heavily on Elizabeth Parrott to coordinate. But I do think we're upholding visibility and people feel comfortable to call when they have a question. Certainly we had a number of those last year, as Brian was mentioning, with the volatility, walking people off the ledge, so to speak, but a number of good conversations throughout the year. The rest of that section, I included some information from Empower. Connie Reddick is our main relationship manager, and so it's somewhat of a recap of 2022, some highlights, and then future going, what the outlook looks like for 2023 and initiatives. And then in conjunction with Connie and on the RHS, Chris Williams, we've developed a good line of communication. We meet on a monthly basis with Connie, all of us, and just ensuring that we're in sync with everything. And so it's been, I think, a good enhancement in terms of communications across all stakeholders. Any questions about education, participant education?
One quick question.
Yeah.
On your Empower Retirement Participant Marketing, is this overall or township? Because are our millennials the most engaged here in the township?
Township specific, I mean, they've got certain calendar-driven touches that they want to highlight throughout the year.
It's good to see, though.
Yeah. So
They're already thinking of it.
Connie went over this dashboard piece on a recent call. And certainly, if you have questions and need her official comments on anything, I can get that detail for you.
No, it's just nice to see that they're already thinking of the future.
Yeah, yeah. Into tab 3, draw your attention to page 17. I apologize, the page number got cut off. It'll be just after the title page in tab 3. And we have total assets in the 457 401A. I'm on the lower right corner, 43, just north of 43 million. And again, as Brian alluded to, we had I was here with Brian back in October, and a good little run in the fourth quarter, so some appreciation to report, which is always nice for participant accounts. Good asset allocation across the board, not surprising. Higher concentrations you'll find in terms of percentage of total assets in the large cap domestic equities, value and growth, but those funds have been holding up well. And I've got the two plans split out individually on the subsequent pages, but we will skip to page 20. And I always think, especially from a fiduciary standpoint, it is always worth the exercise to go through the cost element. And I talk a lot about this with anyone I'm meeting with. We're not trying to bury any of the costs. We want to be transparent with that. So if we look at the weighted average cost of the plan, on the bottom right of this page 20, you'll see that it's currently weighted average all-in cost of 61 basis points, or 0.61%, or 0.0061, and that consists of three cost components. So there's the cost of the funds, expense ratio, and those are all institutional share classes, so the lowest, the leanest expense ratio available in those respective funds. Our advisor fee, right now at an effective rate of 18 basis points, 0.18%, and then Empower's record-keeping fee of 0.06%. So those three cost components bring you the total cost of the plan. And this actually came up last night when I was talking to the firefighter, because his question was, well, I've got $500,000 in total, and should I hire an advisor? Should I not? And so my job is just give them information to help them make an informed choice point. But okay, if you take that $500,000 outside of the plan and you go and take bids from advisors, they may charge 1% plus the cost of the funds. So your all-in cost may be significantly higher, and maybe you can enjoy the economies of scale by keeping it in plan. So we have all those types of discussions. So that it's a relevant data point for you to know as well, just to be aware of. Any questions on that?
So Rob,
Yeah.
I think last year we were at 0.65, and these are for both the 401 and 457, right?
Yes.
Okay, so we've come down 4 basis points from last year. I guess that's probably due to mix, and also due to now that we're investing more, I think your rates have come down a little also.
Yeah, we'll continue to slide down as assets continue to grow, but certainly the way the assets are positioned relative to the expense ratio of those respective funds, you'll see some fluctuation there, plus or minus. Generally, we like to see a decreasing trend with costs overall. I have on page 23 the retirement health savings plan. And so that's a smaller plan. It's not administered per se by Empower. It's administered by a third-party administrator, Avabin. And so its cost structure is different than the two bigger plans, but want to report that to you. Actually, I skipped ahead. In addition to reporting the cost, benchmarking is important. I didn't want to skip this. On page 21, just so you see that, I offer the all-in cost on a weighted average basis and on an average basis for the plan on the upper portion of that page 21, and then some relevant benchmarks below. Again, that gives you some context, because if you take like-sized plans across the 401k defined contribution universe, and looking at metrics such as average account balance, total size of the plans, they're all priced a little bit differently, but so we try and pick best fit in terms of a comparable. And it's nice to see that, hey, from a from an industry benchmark standpoint, we're under benchmark. Now to page 23 is the total cost structure of the RHS plan. So again, this plan is 3.5 and change million in assets. Total cost structure is 1.05%. I know this is something I've talked to Brian about. We'll revisit it, but Avabin said, hey, if we can propose a new service agreement, if you want to make a commitment for a certain amount of time, and they can bring down their asset base fee from the current cost of 76 down to, I think they quoted at 56 or something, but I can talk to you about that. You know, if they're best fit for going forward, might make sense to do that. And again, I benchmarked that plan for you on page 24. So on a relative basis, yes, RHS plan's higher than the 401, 457, but if you look at that plan individually, a $3.5 million plan to the universe, still price efficient or cost efficient.
And Rob, if I can make a comment.
Yeah.
Last year, we were at 1.1, so we've come down 5 basis points. And in terms of you know, making a longer-term commitment with Avabin, we've had some, I guess, to say we want to continue monitoring their performance before we lock in.
Understood. Yeah, and trying to wiggle through some administrative kind of back office things, and but yeah, I fully appreciate that. Yeah. I will, let me skip ahead to section 4 on performance. Again, in the DC universe, how different, what difference does 3 months make? Well, in this case, the fourth quarter was a nice run for participants. It's interesting. Everyone gets their fourth quarter statements and they're hyper-focused on the 1-year return, and I have been very diligently giving them the 3-month return and year-to-date returns, just to be mindful of, hey, things change on a dime, and did you know you're in a, for instance, American Fund Zero Pacific Growth, it was down 22% for the entire year. It's up 18% in the last 3 months, and sometimes that takes the anxiety away from participants that are wanting to pull that trigger at just based on emotions. In terms of our analysis, you know, again, I won't, it's granular in terms of going fund by fund, and we're looking at fund, qualitative, quantitative measures, performance, risk, management tenure, et cetera, stacking it versus its category versus an index. Where does that fund rank in terms of its category, its peer group, and making a decision. Is it fun? Is it checking the box, or is it stumbling? So what you see on page 30, if you can go there, is just a summary. And you'll see that by and large, the majority of funds in that top half of that page are listed as performing as expected or better than, based on our independent review. Couple of funds that I would call stumbling, but on watch, so to speak. Watch doesn't necessarily mean bad fund, just means, okay, they've lagged peers on a more sustained basis, maybe 3 and 5 year, maybe they're underperforming their peer group. But it's always been an exercise in patience to see if a fund rights the ship. Sometimes it's just as simple as, hey, if a, take Invesco Global, for instance. It's a global fund. It's about 60% foreign, 40% U.S. It has much higher concentration in consumer cyclicals relative to benchmark, higher concentration in technology. Well, those two sectors didn't do so hot in 2022, so that kind of explains away some of the underperformance near term. And in fact, if you look at that fund over the last 3 months, it ranks second in its peer group. So I'm saying all that just to reinforce the idea that it's never my desire to come here and just feel like we've got to make change just to act like we're doing something for change's sake. we always want to pace those moves and track the funds and give them some breath before we make a decision. We did go through a fund change recently. It was the first one since we transitioned over to Empower several years ago in the small cap value space. So that took place in November. But we want to be careful about those types of moves. So at any rate, you have those 3 funds, quote unquote, on the watch list right now. And we'll continue to pace those. But all in all, I would say this continues to fire on all cylinders in a good way. And, hopefully you hear from me that I'm paying attention to the education. I feel like that is our firm's primary responsibility to make sure the participants feel like they've got a resource. So hopefully you feel good about that.
Questions for Rob? Sure.
Rob, on page 30, you reviewed this, but I was looking to dive a little deeper. On the funds performing as expected or better than expected, you indicated there's your independent review in that category. So besides, say, a fund's performance versus its peer, what other factors are you using to decide to say that these funds are performing better or at as expected?
Yeah, you know what, I guess if you'll allow me just to give you an example, why don't we all head to page 44. And yeah, I apologize, I don't want to ever gloss over. What I don't want you to think is we're just chasing performance, 10-year, 5-year, 3-year, and okay. And again, there's tons of data points we can look to for each of the funds. What we've tried to do is succinctly narrow it down to the data points you see on page 4, top row. So we've got the funds listed. I've shaded them independently just based on which plan, and in this case, the fund, it's the same share class, whether you're talking about 401A, 457, or the RHS plan. So going left to right, you've got the performance of that fund, risk measures, so aggressiveness of the portfolio, and then alpha score, are investors being rewarded for the level of risk they're taking, PE ratio, number of holdings, median market cap, what's the average size of the fund, of the portfolio holding, management tenure. Sometimes that can be a little skewed when you have a management team of 4, 3 young guys, 1 tenured, brings down the average, so you want to peel that back a little bit. Expense ratio and overall size of the fund. How nimble is the fund relative to peers? And these aren't the only data points, but if we can stack that group of data points on top of the category, second row down, how does it compare? Look at an index. The quintile rank is a good indicator. It's a very easy way to kind of interpret, okay, how is this fund doing based on raw performance versus this category? And this is, I did cherry pick this one, but it is a good indication. It's, yeah, it was down 29% last year, but on a relative basis, first and second quintiles across the board, all time frames, that's a good, solid fund offering in the large cap growth space. And then I did include sector weightings down at the bottom, and that's important too, because again, it can explain away some of that near-term volatility, over underweight in a certain sector. So we're trying to make make an informed decision on, is a fund holding its weight, or do we have reason to look under the hood a little bit more? Not a perfect science, I admit that. Sometimes there's art involved, and sometimes the best thing to do is just put it on watch and pace it for a while. We've seen, if you look at Nuveen mid-cap value, that was one fund we had on watch for two full years, and it's turned into a nice performer recently. And again, just sometimes you just have to take into context what's going on in the market and let that fund breathe, the managers breathe a little bit. Does that answer your question?
It does.
Okay.
And then, of course, all the participants want the best options they can. Everyone wants to overperform the market or the sector.
Yeah.
And there's no magic to it, but I just wanted, you mentioned that there's your own sort of independent judgment as to this category here. And so, maybe just a question that helps give everyone assurance that you're looking at these funds.
Yeah, that's good.
In a comprehensive way to make sure that everyone's getting the best possible.
It's good for you to ask it that way. In short, try and make best-in-class funds within the fund, and it's not always a perfect science, but yeah.
Any other questions? Rob, would you review the investment policy for healthcare? Do you see in going through it? We updated this last year and adopted it. Is there any changes that you would think would be necessary?
Yeah, I was thinking, as Brian was addressing his portion, Brian, that's the most amount of times I've mentioned your name on mic. I like it. No, I think like an example would be if the decision was made to add a self-directed brokerage window, we want to incorporate that verbiage inside the, but within these DC plans, we're not dealing with, specific percentage over underweight in equities versus fixed. I mean, it's participant-driven accounts. So the majority of the investment policy, what types of asset classes is the plan offering, and that hasn't changed. It's from conservative to aggressive, and then how are those funds being evaluated. So that's spelled out in the investment. What I just mentioned to you verbally that we tried to capture in print. So there's no material changes to that. So I would say that what the current version holds up.
Okay, thank you.
Yeah.
Are there any other questions or comments with regards to defined contribution or 457s? Okay.
It's really nice seeing everybody again.
Thank you, Rob. Appreciate all that you do for the township.
All right, thanks.
Next, we will go to the investment policy review just formally. We have as we just talked about, the defined contribution, the defined benefit, as Brian Green discussed, retiree health care, and then the general investments, which is the township option, which is the short-term investments, which I reviewed earlier. Is there any discussion from the either the board or the committee with regards to the actual policy? Okay. So last year, again, we did have changes or suggestions that we then took to the board for its adoption. This year, with no changes, I would just note that we reviewed them and we will move on. New business. Any new business from the board? Okay. The next Financial Sustainability Committee meeting is set for April 26, 2023 at 8 a.m.
Will we get a calendar invite for that, or?
You will. You will. And if there's no other items, I'll look for a motion to adjourn.
Motion.
Okay, Chris. David. All in favor?
Aye.
Any opposed? Okay, we are adjourned. Thank you.